Another gold target, but this is not provided yet by physical geometry. That would be north of 3,300. It might fit to that. But this I want to see, because it could be with outflows of American stocks. That could be a possibility of having silver 43 and gold 3,300. But I'm pretty doubtful because of the chart I showed before on the negative correlation with bonds. And the recession would actually put some of the gold money into bonds. So there's not enough left, in my opinion, right now, for reaching 3,300. You know what I mean? This is a lot.
There is a potential target for gold to reach $3,300, which is uncertain due to market conditions. While a shift from American stocks could drive silver to $43 and gold to $3,300, the negative correlation with bonds and a potential recession may lead investors to move money into bonds, limiting the upward movement of gold. Therefore, reaching $3,300 seems unlikely for now. ChristianVartian is a seasoned financial expert known for his in-depth analysis of global markets. He explains gold attracts investment from its usual holders and investors fleeing the treasury markets for various reasons. Some of the money in gold could return to treasuries if they offer safe, reliable returns, such as a 4% interest rate. However, gold remains appealing because it has no counterparty risk, unlike treasuries, which are essentially claims on the government. This unique attribute makes gold a preferred choice during times of uncertainty or when investors cannot trust other assets. Christian discusses the complex relationship between gold, treasuries, and stocks. If treasury prices rise, yields fall, gold may lose some of its appeal as money flows into treasuries, and stocks could also suffer from this shift. However, if the stock market becomes more bearish, money could flow out of stocks and into gold, compensating for the outflows from the bond market. Essentially, these movements are influenced by liquidity and the broader economic context. While there may be temporary outflows from gold, a bearish stock market could result in more money flowing into gold, balancing things out. We're about to explore the video, but first, subscribe and hit the bell icon to keep up with our newest uploads. Your feedback in the comments is always appreciated.
We have to understand that gold, actually, besides its normal customers, its normal holders, attracted tourists who fled the treasury markets for diverse reasons. And a part of the money in gold might go back to what they would like to be in case they could safely be there and get their 4% interest.
I was going to ask, is there a threshold price where you think money starts to accelerate moving out of gold? Is there like a 5%? Is it 5.5%? Do you have an idea of where that price level might be, or that coupon level?
Not really. The point is, if you think reasonably, let's imagine you have trillions to park, and you would be in the situation that you don't trust the counterparty, or you are sanctioned that you can't invest in a counterparty's asset. But then you have to choose something which has no counterparty, and the only thing on the planet which is known to everybody, which has no counterparty, is gold. Gold doesn't need a counterparty, so it's not a claim, okay? A treasury is a claim. It's just a claim. It's nothing else. But gold is a thing. It's not a claim. And what we saw actually is moving a lot of money instead of into treasuries, into a non-claim, a thing, which is gold. Yet, scenarios do not happen ceteris paribus, okay? Scenarios happen in a context. And it might well be, and that's actually what our indicators are saying, that a bull market in treasuries would actually result in a bear market for stocks. Because in stocks is much more tourist money, which normally would be in treasuries, than tourist money in gold. And now, in case that would happen, even outflowing money out of gold could be compensated by inflowing money into gold, but the inflowing money would be from stocks. So things happen in a context. It is pretty sure that if treasury prices recover, that means yields go down, gold is going to lose money to the treasuries just in the same moment if yields go down and treasury prices go up, the stock market is also going to lose money. And if the stock market is getting more bearish, that might even cause more money flowing from stock market into gold than gold would lose to the bond market. I know it's complicated, but it's the reality. We measure it.
Christian highlights that basic alpha feeds operate on nominal values rather than quantitative data. A 0.9% decrease in spending alongside a 4% price increase results in 1.3% fewer goods sold. When projected over 12 months, this trend signals potential economic concerns. However, this data challenges the standard narrative that inflation is purely driven by excess money. Christian points out that such figures wouldn't be possible if inflation were demand-driven. Instead, the data suggests that rising prices are due to supply shortages rather than increased consumer demand. This means the current price increases result from scarcity, not inflation in the traditional sense, and could be addressed by resolving supply-side issues. Christian exposes that the standard narrative suggests that inflation is always demand-driven. When people have too much money and interest rates are low, prices rise, and prices fall when interest rates are high. This is widely accepted, even by the Federal Reserve. However, this theory only applies under certain conditions that are rarely examined. If the foundational assumptions of an economic theory don't apply, then the theory itself doesn't function properly. The real issue isn't only interest rates and the amount of money in circulation. The belief that high interest rates must always be restrictive ignores the possibility of combining high interest rates with an expansionary monetary policy, K. Historically, this approach has been used successfully. If policymakers continue following flawed economic theories, interest rates should be around 2 to 2.5%. However, if they shift toward a more sophisticated strategy, rates could be around 4% while maintaining ample liquidity. This would encourage money to flow into more productive sectors, creating a sorting function where capital is allocated more efficiently. Now, let's get back to the interview.
Basic alpha feeds are running on the nominal and not on the quantitative. But 0.9% less spent with a price increase of 4% is 1.3% less sold, sorry. And if somebody puts that into an equation and multiplies by 12, he's going to get a pretty alarming signal. Anyway, it shows something else for sure. And this is if the narrative of demand side and that means money side driven price increases would be correct, such data would be impossible. So if the demand is driving prices up because there is too much money, which would be inflation in a correct sense of the word, such data would be impossible. So if you sell 0.9% less with a price increase of 0.4%, it actually means that it's a scarcity price increase. Sorry, that's the supply side. It's not the demand side. And the supply side price increases are not inflation. But it thinks that everything is demand side driven. So if people have too much money, if there is low interest rates, then prices go up, and if there is high interest rates, prices go down. This is actually what they tell you in basically every media, including the Fed's chairman. But in reality, that might be correct, but only under certain circumstances. And nobody is discussing the parameters if we are in a circumstance where this is correct. And according to not only my opinion, we are not in circumstances in which this is correct. So every economic theory is based on an axiomatic baselines. And if they are not valid, then the theory is not functioning. There's nothing else than that to say.
Christian, you wrote in one of your newsletters, you write that interest rates are way too high. Where should they be?
First of all, the bigger problem is the quantity of money. So one has to imagine that if we would have scientifically more skillful people, they would at least imagine a possibility of high interest and QE. I know that the last 35 years, nobody was ever thinking about high interest rates and QE because they always thought about interest rates must be restrictive if the quantitative policy is also restrictive, and nobody ever thought about one being restrictive, whereas the other one is not restrictive. So in the moment, with the theory drivers in place in the heads of the Fed officials, if they continue to work like that, a proper interest rate set is around 2 to 2.5%. I say, if you want to continue to use that relatively wrong economic theory, if you would instead follow the ideas and goals of the US president and come back to more sophisticated theories, you could well have interest rates around 4%, but that should be actually joined with QE. That means you would have an expensive monetary quantity at relatively high prices.
The financial markets are shaped by complex interactions between gold, treasuries, and stocks, influenced by liquidity and broader economic conditions. While gold remains a safe haven asset due to its lack of counterparty risk, its upward potential could be limited by investor shifts toward bonds during economic downturns. Inflation is not solely demand-driven, as supply-side factors also play a significant role. A more balanced approach to monetary policy, combining high interest rates with an expansionary money supply, could lead to better capital allocation and economic stability. How might geopolitical events impact investor confidence in gold versus U.S. treasuries? What historical examples demonstrate the effectiveness of high interest rates combined with an expansionary monetary policy? Share your feedback in the comments below. If you found this helpful video, hit the thumbs up and subscribe to keep up with our latest updates. We appreciate you being a part of this journey.